Okay, hopefully you guys enjoyed the previous video on the DR and IDR and explaining the ranges and how to trade this strategy. In this video, I'm going to show you a few ways to determine your bias for the day based on the DR and IDR ranges. These are known as the daily cycles. So the daily cycle of the DR and IDR ranges, there are 4 of them. The first one is going to be a bearish expansion. So if you look at the Tokyo DR and IDR range, and then the London DR and IDR range is below the Tokyo range, our bias is bearish. This is known as a bearish expansion. Conversely, a bullish expansion is when the London range is above the Tokyo range. We are now bullish in our bias, and we are assuming that price will break out above. And if it does, we are taking a trade because our bias shows us that the trend is going up. The next one is called the Megaphone pattern. That's when the Tokyo session is narrow and the London session DR and IDR ranges are completely above and completely below the Tokyo session ranges. The reason it's called the Megaphone pattern is because it looks like a megaphone from the 1950s. The last one is going to be the contracting model. That's when the Tokyo range is larger than the London range, and the London range of the DR IDR levels live within the Tokyo session. At this point, you usually see a lot of consolidation during London and then an aggressive breakout either above or below. This is a 50-50 shot whether it's going to go up or down, but when it does, it usually does it aggressively. Now, the Megaphone pattern and the contracting model are not common occurrences. They happen occasionally, but more often than not, you're going to see the bullish or the bearish. Usually the only time the Tokyo session DR and IDR ranges are larger than the London session is when it's a JPY based pair like GBP, JPY, or Australian dollar, US dollar. Now, this is going to be your example of a bullish expansion model. As you can see here, we had the Tokyo session range and the London session range. London session above Tokyo session, our bias is bullish. So using the same strategy as before, this candle right here is our confirmed breakout of the DR range. Now we take the chart to the 1-minute time frame. We look at our areas of interest, and then our last one is going to be this range. So straight into that fair value gap, reject it up, and we got our entry signal. Taking a long position there, going for a 1 to 1.5 risk to reward. And that's how you trade the bullish expansion model. It's the same concept for the bearish expansion model, except this is for sell positions. We had our Tokyo session. We have our London session. It's below the Tokyo session, so we are bearish. We have our confirmed breakout on the 5-minute time frame. We mark up our zones, fair value gaps, as well as the DR IDR range right here, and opening to 50. Again, we're looking for a pullback into one of these 3 areas, and then looking for our sell signal on the 1-minute time frame. So switching over to the 1 minute, we have our entry signal and a rejection off the DR IDR range, sell position, 1 to 1.5 risk to reward, and we have our successful trade. So here is an example of the Megaphone pattern where the Tokyo session lived within the London session. And usually during days like this, you don't want to trade because what you're expecting is a ranging market. And as you can see here, the market just ranged and kept sitting in this area all the way through the next day. If you do like trading ranging markets, which I don't suggest, you only want to sell at the top and buy at the bottom and stay within this range. So lower half buys, top half sells, and then once it crosses over into the other half, get out of your position. All right, contracting models are very hard to find. Even this one doesn't quite qualify because this range isn't completely within the Tokyo range, but it's close enough. Essentially what you're getting here is tight consolidation and then shooting up either up or down. For this example, we went up, and the same rules apply. The only caveat here is I would focus on the Tokyo session DR and IDR, not the London DR IDR. So you mark up your zones, fair value gaps in the 50. Once we had our confirmed breakout, you take it down to the 1-minute time frame, wait for a pullback. We don't take that position because we're looking for longs. Take our long position, give us a nice healthy stop loss below that fair value gap, and a 1 to 1.5 risk to reward. And you have your winning trade. So a key area to consider when looking at trade entries, and specifically areas not to trade, you don't want to take any longs or short within the Tokyo range. This is used as support and resistance. Getting stuck in this or wicks above and below are very common. As you can see here, had price move into the zone and reject up. You absolutely do not want to enter a trade within the Tokyo session. So just to show you really quickly that whatever session that you are available to trade, whether you live on this side of the world where you can trade Tokyo session, or you have a full-time job in America and the only time you can trade is at night, Tokyo session is perfect for you. If you live in Central Europe, you're usually going to stick with the London session. Or again, if you have a full-time job, you're just going to wake up early and trade the Tokyo session. Whatever session you trade, you can just focus on this one DR IDR range and use the same concept for each session to enter a trade. So we had our confirmed breakout right here in the Tokyo session, waiting for a pullback into your areas of interest, like the DR IDR zones or fair value gaps in the price. Get your confirmed trade entry. This one's a bit out of the range, so we just go to the previous swing high and you get your 1 to 1.5 risk to reward. Then you wait for London session to form. You get your confirmed breakout of the DR IDR levels right here. Take it down to the 1 minute time frame, enter in a long position, and you got your trade entry. I forgot to show you marking up zones, but nothing changed. The lower 50, the DR IDR range of the breakout, as well as the fair value gap that caused the break. So this was our confirmed breakout on the 5 minute time frame. Our bias is now long, so we ignore all of the short positions. We take the first long position on the 1 minute time frame once it rejects one of our 3 zones, 1 to 1.5 risk to reward. Wait for New York session to form. Confirmed breakout of the DR IDR zones. Mark up your areas of interest, fair value gaps, and the top 50. Again, just to reiterate, you're looking for pullbacks into one of these 3 zones, and then a signal bearish because we broke out of the lower half on the 1 minute time frame from one of these 3. To the 1 minute time frame, we have our signal right here. Enter in a short position above the DR IDR range for your stop loss, because that's your zone of interest, targeting a 1 to 1.5 risk to reward, and the trade plays out. You can do that for every single session. So if you're one of those traders that has restrictions on when and where you can trade, this is the strategy for you.